When we think of investing, it's easy to get caught up in the excitement of rapidly changing stock prices, market trends, and the latest financial news. But value investing is a discipline that takes a step back from the noise and focuses on something much more fundamental, the true worth of a company. Basically, value investing is about identifying companies that are trading below their actual value, the true worth of their assets, earnings, and long-term potential. In other words, value investors look for stocks that are, for some reason, undervalued by the market. This could be due to short-term problems, market sentiment, or temporary economic conditions. But the idea is that the market has mispriced the stock, and over time, the true value will emerge. So how does a value investor determine whether a stock is undervalued? This is where the principles of value investing developed by Benjamin Graham and popularized by Warren Buffett come into play. First, fundamental analysis is key. Value investors focus on the fundamentals of a company, its earnings, revenue, debt, cash flow, and growth potential. They analyze financial statements carefully, looking for companies with strong balance sheets, consistent profitability, and sound management. The goal is to understand the business and evaluate whether it is financially healthy enough to withstand challenges and prosper in the long run. Second, value investors emphasize the importance of having a margin of safety. This is the difference between the current stock price and its intrinsic value. Buying a stock with a margin of safety provides protection against unforeseen risks or miscalculations in your analysis. If a stock is trading significantly below its intrinsic value, even if some things go wrong, the chances of losing money are lower. Warren Buffett, perhaps the most famous value investor of all time, once said, "Price is what you pay, value is what you get." This distinction is critical. The stock market can be emotional, with prices rising and falling based on sentiment, speculation, or short-term events. Value investors don't let these fluctuations drive their decisions. Instead, they focus on the underlying value of the business itself, believing that in the long run, the market will recognize and reward this value, which in a lot of cases actually happens. Patience is also a hallmark of value investing. Unlike day trading or trying to time the market, value investing requires a long-term mindset. Often it takes time for the market to correct its pricing errors. This is why value investors are willing to hold on to their investments for years, sometimes even decades, allowing the stock to appreciate as the company's value becomes more recognized. Now you might be wondering, if value investing is so effective, why doesn't everyone do it? The answer lies in human psychology. Value investing requires discipline, patience, and often going against the crowd. When others are selling in panic, value investors are looking for opportunities. When a stock is out of favor, they see potential. It's not always easy to stick to this approach, especially when the broader market is moving in the opposite direction. But those who can maintain their conviction often reap significant rewards. To close, value investing isn't about finding the next big trend or gambling on the hottest stock. It's about being methodical, rational, and always focused on the long-term health and value of the businesses you invest in. It's a strategy that has stood the test of time and continues to be a powerful tool for building wealth. Subscribe for more advice about investing and finances. Hope to see you next time.